Things have gotten weird lately. We've got rampant inflation, rising interest rates, both of them happening at the same time. And then in January 2022, we saw a pretty substantial drawdown in basically all asset classes. Some people are calling it the everything bubble. This had me wondering, how has Ray Dalio's all-weather portfolio performed during this time? Because Ray Dalio's all-weather portfolio is intended to be resilient through 4 economic seasons as he sees them. And they are higher than expected inflation, lower than expected inflation, higher than expected economic growth, and lower than expected economic growth. I think we can all agree that we are in a time of higher than expected inflation right now. And the economic growth thing, we were certainly in a weird predicament there because economic growth was kind of slowed by COVID, but then central banks kind of propped us back up to where we would be anyways if we didn't have COVID, at least speaking in terms of GDP. So yeah, it's just a really weird scenario there. So let's take a look at the all-weather portfolio, see how it has performed recently, particularly over the last year and over January of 2022. Right now I'm recording this, it is February 1, 2022. This has been on my mind and I've been very curious about how this portfolio would be holding up. So let's take a look at it here. Now, for those of you guys unfamiliar with the all-weather portfolio, maybe you need a refresher on the all-weather portfolio. It's an asset allocation concept by Ray Dalio that allocates between 5 asset classes. And those asset classes are U.S. equities at 30%, long-term treasuries at 40%, 15% intermediate term treasuries, 7.5% commodities, and 7.5% gold. So yeah, 55% is allocated basically to bonds here. And we're going to compare it to a global 60-40 moderate growth portfolio, 60% equities, 40% bonds. You can see the breakdown here, 39% US stock, 21% global stock. This is just here to be representative of a 60-40 portfolio that's going to be pretty close to what you would get from any advisor, any firm, institution, whoever is going to put you in into an asset allocation at 60-40. This is pretty much just kind of a broad 60-40, here you go type of portfolio that's pretty reflective and effective if you want 60-40 exposure. So yeah, we're going to take a look at it compared to that. And it's really easy to backtest this to January 2007, which we've done here. And we can see on the chart, Ray Dalio all-weather portfolio, the blue line, red line being the 60-40 portfolio. Going back to January 107, we can see that blue line kind of smoothly trends upward and didn't have much of a dip here in the great financial crisis of 08 and 09. With some numbers behind it, the all-weather portfolio is a 7.09% annual compound annual growth rate. I said that backwards. 60-40, 6.72%, so they're very close. But if we look at drawdown, the all-weather portfolio only has a drawdown of 14.75%. The 60-40 portfolio is more than double that at 33.55%. Sharpe ratio is going to be reflective of that here with the all-weather portfolio at a 0.91 Sharpe ratio and 0.61 60-40 for the 60-40. The Sharpe ratio is a measure of risk-adjusted return here. So when you see low drawdown and a pretty stable return, it's going to have a higher Sharpe ratio. Standard deviation, 6.94%. We could call this volatility, 9.91% for 60-40. So this thing is less volatile than the 60-40 portfolio. And we can see it's performed incredibly well here from 07 going forward. But this is just 07 going forward. I wanted to do some research to see if we can find anything on how it would have performed further back in time. And what I found here was this blog post from Ben Carlson, who writes A Wealth of Common Sense. He's also the host of the Animal Spirits podcast, a very good podcast. And he did some research on it here back in 2014 when it was initially published by Tony Robbins. Ray Dalio kind of collaborated with Tony Robbins, I think, on a book, and that's where he released his concept of this all-weather portfolio. That was back in 2014 or so. That's why this post is coming from 2014. That's when it was on his horizon, on Ben Carlson's horizon. So anyways, he did some research here, and what he found, let me see if I can highlight it in here. Here we go. This is what I'm looking for. From 1972 to 2013, the annual return was 9.5% with a volatility of 7.9%. The largest loss was negative 4.2%. I believe this is a typo. I strongly believe this is a typo. I've not reached out to Ben Carlson to confirm it or not, but Negative 4.2%, that would be incredibly freaking low. Like if that's the case, why not just lever this thing to the moon? I mean, some people already propose levering it, and I have researched levering it. That's a whole nother topic. But at that rate, you could borrow 10 to 1 and lever this thing up damn near safely. Anyways, yeah, if we look at this little back test here, the largest downside was negative 14.75%. His data was going through 2013, so that would include the recession of 08-09. So I believe that this should either be negative 14.75 or maybe negative 14.2 using the data set that he was analyzing on. The bottom line is, though, so it held up fairly well during the 1970s too. The 70s were a weird period as well, where the stock market was kind of bubbly, we had high inflation, and I think rising interest rates too at certain points there in the 70s. So it was just a weird kind of go nowhere decade largely for the 70s, or at least kind of maybe the end of the 60s through mid to end of the 70s there, or basically a go nowhere 10-year period. Yeah, so this portfolio held up pretty well during the 70s. That's what's interesting. Now let's look at it here in context of today. That's what I was really interested in. So I'm going to set this chart to go from 2021 to 2022, and this is only going to have January 2022 in it. But we can see here the all-weather portfolio has underperformed the 60-40 portfolio. We can see a kind of nice drop in the all-weather portfolio early on here, while the 60-40 portfolio was spiking earlier in the year. And then as things went on, things kind of leveled out, and then there's the 2022 drop. Interestingly enough, the 60-40 portfolio had a larger drawdown, slightly larger drawdown than the all-weather portfolio. I know it doesn't look like it in this chart here. Let's switch it to log. And when you switch it to log, you can see a little bit more of the drawdown that the 60-40 portfolio had here, and I think here is probably where it had its largest drawdown. We can look at that a little bit better by going here. Yeah, okay, so the 60-40 really had its drawdown in January 2022. Equities, bonds, kind of everything went down there. The only thing that went up was commodities during that time period, and the all-weather portfolio certainly benefited from that. Early on in 2021, bonds took a big hit and then stocks went up. We can put that on the chart here. We'll just put long treasuries at 100 and we'll use benchmark. Yeah, let's rename this. Right, so when we put these on here, you'll see the S&P 500 spiked early in the year while bonds were dropping. So we can see green line being S&P 500 spiking, yellow line bonds taking a big hit there early in the year in the first quarter. Second quarter, things kind of went up a little bit, and then third and fourth quarter, things were pretty level. So the 60-40 portfolio early on enjoyed a big spike, larger spike from stocks than they got a drawdown from bonds, and they benefited from that. The all-weather portfolio was really at a really kind of catching the crux of this thing, because it's got 40% exposure to long treasuries, 15% to intermediate term treasuries, so 55% exposure to bonds, and then a relatively little 30% exposure to U.S. equities. It was definitely kind of taking a piss there early in the year. But the big thing to point out is in 2022, so far, that first month, January 2022, it didn't go down as much, and that's largely being pulled up by gold and commodities, both of which are going up. So yeah, what do you guys think of the all-weather portfolio? Let me know in the comments below here. What do you think of the all-weather portfolio? What's it going to do going forward? That's really the big question. What I see here, I'll tell you what I see. I see valuations in basically all equity asset classes United States based, US based. It's very important to say, because globally based, internationally based equity valuations are relatively low. But locally here in the United States, domestically, equity valuations are really high. And then we've got the rising interest rate. So I kind of see it, as if I'm making a forecast, and mind you, forecasts are usually entirely wrong, but it's always fun to make these things and then come back to them and see how accurate they were here. And with making the video, I'll be able to come back to this in a year, 10 years, and see how accurate I was. But I think that U.S. equities are going to be facing a headwind, particularly as the interest rates rise. It's going to slow them down a little bit. But then people are going to realize, hey, these things are really overvalued and they can't sustain themselves without low interest rates. They can't sustain themselves as interest rates go up. And then, hey, global equities are also a big opportunity at this time. Their price to earnings ratio, or the CAPE ratio, cyclically adjusted price to earnings ratio, is very attractive relative to US equities. I've touched on that in some of the other videos I've done. So possibly US equities could keep declining, or at least have slow, retarded growth relative to global equities. Rising interest rates are probably going to hurt bonds, or at least slow their growth a little bit. Then we got commodities. So we got inflation going to keep driving up commodities. And if those things, and that little forecast and where I'm seeing things in my head plays out that way over the next year, well, the all-weather portfolio is probably going to do pretty good because of its exposure to commodities and gold. It could be slowed down. It would really depend on what equity markets do. It could underperform that global 60-40 if foreign equities really take off and U.S. equities really slow down. It's one way of looking at it. I think that the all-weather portfolio is going to continue to be pretty resilient and deliver about 60-40-ish returns with minimal drawdown. And, judging or considering who the portfolio was developed by, Ray Dalio, there's no reason to kind of assume anything else, right? Like, he didn't come out and publish something that certainly wasn't well researched. So yeah, what do you guys think on the all-weather portfolio? What do you think is going to happen with it? Let me know in the comments below. That's a wrap on this one, guys. I'm signing off.